We've simply been driven by emerging market reactions over the last little while. The rand has strengthened a lot. And the reason we're so sensitive to emerging market concerns is we sit with a large fiscal deficit, we sit with a large current account deficit, and in that environment, we are hugely dependent on the global economy. If the global economy improves and you get comments out of the Fed that they're going to be cutting and the ECB making similar statements, then the rand strengthens. And if it is the case that you land up with a very strong number out of the US for jobs and it looks like there won't be as much cutting, then the rand weakens. We're being driven almost exclusively at this point by global factors. It hasn't always been the case. Earlier on in the year, we had our own domestic issues with power and low growth, and we were being driven by domestic factors. But as things stand at the moment, the global ship appears to be pulling us more strongly than the SA ship. We have scored quite a few own goals, but we are able to benefit from the current environment. The stimulus that China is applying is directed towards the housing market. Indirectly, that means steel. There's literally one country in the world that's been able to materially increase its iron ore output over the last year. That happens to be South Africa. Iron ore has been on an absolute tear. It's a large part of our export basket, and as a result, South Africa benefits from this. In terms of the broader trade, it's very complicated. It's not at all clear whether we will be beneficiaries or not from this current environment. If global trade rolls over, which is not our base case, but if it does, there won't be many winners, and it's likely that we won't be one of them. That's one of the risks that we would want to be compensated for. It's one of the reasons why we're hanging fire on global risk at the moment. There are two issues at Eskom. One is production of electricity, and the second is finances. On the production of electricity, the key number there is what's known as the energy availability factor. A number above 73% or so allows for modest growth in South Africa, call it 1 to 2%. A number of 60% allows for no growth. And so our call on growth in South Africa is partly dependent on the global economy, but secondly is very dependent on our availability of electricity domestically. And where we sit at the moment is that the energy availability factor has picked up from its lows of 60 in the first quarter to around about 70. It's been at 70% for several weeks in a row now. And we've had no load shedding. The net result of an energy availability factor above 70% and no load shedding is that we're going to see a bouncing growth in Q2 in South Africa. But based on early estimates, growth is going to be between 2.5% and 3%. A stark contrast to the extremely negative print in Q1, below -3%. Year-on-year growth is still going to be very modest. Given the current energy availability factor and the fact that we've only got 4 or so more weeks of winter to get through where peak demand comes about, we think we're largely okay for now from an energy perspective. But that still leaves the financing perspective, which hasn't yet been resolved. Eskom is sitting in a position where it's unable to service its debt. It requires a bailout from the state, and that may take a number of forms. It's all under consideration at the moment. Will the state take on all of Eskom's debt? Will there be a special purpose vehicle? Are they going to get some form of green bond lending from European developmental institutes on the basis that Eskom cuts its carbon emissions? All of these are things that are being spoken of, but we don't have finality yet. Presumably we'll get that quite soon, but it means that we can half tick the box for Eskom. We're getting sufficient supply at the moment to allow for modest growth at best, but the financing question still remains open, which partly explains why our yields are so high in an environment where global yields have compressed as much as they have. One of the key risks facing South Africa is that government debt, the government debt stockpile, is growing a lot faster than nominal GDP. We either need to see more issuance, and we are likely to see more issuance from government. There's probably going to be a tax shortfall again, given that growth is disappointed. Or we need to see more taxes. We don't see that as being very likely. We think we're on the wrong side of the Laffer curve. You start increasing taxes at this point, it's destructive for growth. Or we need to see a sale of SOEs. That's been hinted at. It might be politically difficult, but we're in a position now where there are few options. And government's got a stake in companies like Telkom. You could question why. And it's available cash that perhaps they'll settle on. There's another option, which is they have to curtail their expenditure plans, which will be aided by low inflation numbers. But the reality is that might be politically difficult, but issues like NHI and other ambitious targets, which we have to delay. We simply don't have the money at the moment to do it and allow for debt to GDP to stabilize. So either we need growth to pick up massively, which doesn't seem possible given the constraint from electricity, or government has to hold back on the expenditure, which may well have a negative consequence for growth itself, but we're in an environment where we have to take a tough choice. There are no easy options at this point. It's always a danger. There always is a possibility of a downgrade from Moody's and us landing up fully in junk status and being removed from various indices which would see forced outflows. But we don't see it as a major risk. The outlook at the moment is stable. Given our forecast, we don't think that that's likely to change. And what's more is it remains fully priced in. Our spread is still high relative to a country like Brazil, which has a worse rating than us. So that would imply that should we land up in a position where the market no longer expects a downgrade, and at the moment the market does, there's still further upside in our bond market off current value. Now, the reason we're waiting in the wings from an equity perspective in SA is that there's been a lot of promises, and the promises look very promising. It does look like we will be able to sort out a lot of the issues in SA, should be able to follow through on the plans. The problem is SA is great at making plans. We're not so great at following through. And so before we start to allocate meaningfully and start buying the dream and seeing SA growth pick up materially, we want to see firm evidence. We're cautious by nature. We have to be. We allocate people's money. And as a result, we're not extremely negative on SA. We think a lot of the bad news is in the price. But we're not jumping in feet first either. We want to wait to see signs. We want to see shovels hitting the ground before we take a view that SA growth is turning around. And there's little sign of that happening immediately. So we'll wait keep our gunpowder dry and wait for that to come about.